The stock market can seem scary. Don't worry, it's a place where people buy and sell pieces of companies. These pieces are called stocks. It's simpler than you think. Imagine it as a marketplace where you can own a part of your favorite companies. Companies need money to grow and expand their operations. They get this money from the stock market by selling shares to the public. Think of it like a big store where companies sell small pieces of themselves. These small pieces are called stocks or shares. When you buy a stock, you own a part of that company. When a company first sells stock to the public, it's called an IPO. IPO stands for Initial Public Offering, and it's a big event for any company. For example, Facebook did an IPO in 2012. It was a big deal and attracted a lot of attention. Facebook sold a lot of stock and raised a significant amount of money. They used this money to help their company grow and innovate. People buy stocks hoping to make money as the company grows. They hope the stock price goes up so they can sell it for more money. If the stock price increases, they can sell their shares for a profit. Alternatively, they hope the company makes a lot of profit. Then the company can share some of that profit with them. This is called a dividend. Remember, buying stocks is risky. It's important to be aware of the risks involved. Stock prices can go down too, and you could lose money. Always do your research before buying stocks. Understanding the market can help you make better decisions. Stock prices go up and down. It's like a roller coaster. One moment they are soaring high and the next they might be plummeting. This constant fluctuation can be thrilling, but also nerve-wracking for investors. Lots of things make stock prices change. These factors can be both internal, like a company's performance, and external, such as economic conditions or global events. Sometimes good news makes stock prices go up. Positive developments can boost investor confidence and drive demand for the stock. Maybe a company invented a popular new product. Innovations can lead to increased sales and higher profits, which attract investors. Good earnings reports also make stock prices go up. When a company performs well financially, it signals stability and growth potential. That means the company is making a lot of money. Investors are likely to buy more shares, driving the price up. Bad news makes stock prices go down. Negative events can shake investor confidence and lead to a sell-off. Maybe a company is not selling a lot of products. Poor sales can indicate trouble ahead, causing the stock price to drop. Maybe there is a problem with their business. Issues like management changes or financial losses can also impact stock prices negatively. Bad news makes people want to sell the stock. When many investors sell at once, the stock price can fall rapidly. Facebook stock went up and down a lot after its IPO. Initial public offerings can be particularly volatile as the market adjusts to the new stock. First, it went up a little. Investors were optimistic about the company's future. Then it went down a lot. Market corrections and changing perceptions can lead to significant drops. This shows how unpredictable the stock market can be. Always be careful. It's important to do thorough research and consider seeking advice from financial experts before making investment decisions. When you buy stock, you own a little piece of the company. You're like a mini owner. If the company does well, you should get a share of the profits. This is called a dividend. Companies decide whether to pay dividends or not. It depends on how much profit they make. They might use the profit to grow their business instead of giving it to stockholders. Facebook makes a lot of money. Let's say they decide to pay some of that money to stockholders. This is their dividend. The more stock you own, the bigger your dividend. Dividends are a way to make money from stocks. But remember, companies don't have to pay dividends. It's up to them. Section 4. Market capitalization, sizing up companies. Ever wonder how much a company is worth? It's called market capitalization. It sounds complicated, but it's not. Market capitalization is the total value of all the company's stock. Imagine a company has 100 pieces of stock. Each piece is worth $10. The market capitalization is $1,000. Easy. Market capitalization shows how big a company is. Big companies usually have a large market capitalization. Small companies have a smaller market capitalization. Apple is a huge company. They make iPhones, Macs, and more. Apple has a large market capitalization because they are successful. Their stock is worth a lot of money. Section 5. Stock splits. Making stocks more accessible. Sometimes a company's stock price gets really high, making it difficult for average investors to buy even a single share. This can be a problem for small investors who can't buy expensive stocks, limiting their ability to invest in popular companies. That's where stock splits come in. They make shares more affordable and accessible to a broader range of investors. A stock split is like cutting a pizza into more slices. Imagine you have a whole pizza. You still have the same amount of pizza, but now it's divided into more pieces. This means you have more slices to share with others and making it easier for everyone to get a piece. A stock split works the same way. The company divides its existing shares into more shares. A company splits its stock into more shares, increasing the number of shares available. The price of each share goes down, making it more affordable for investors to buy. Apple did a stock split a few years ago to make their shares more accessible. Their stock price was very high, which made it difficult for many people to invest. After the split, the price of each share was lower, allowing more people to buy shares. This made it easier for more people to buy Apple stock, increasing the number of investors. Stock splits don't change the company's value. The overall value remains the same. It's like cutting that pizza into smaller slices. You still have the same amount of pizza. You still have the same amount of pizza, but now more people can enjoy a slice. Please like, comment, and subscribe to our channel for more informative videos.